Hello traders, welcome to the Markets in 3 with me, John, Senior Market Analyst here at Anzo Capital. I'm here to provide you with the latest information in all things FX markets, some key charts to watch, as well as some skills to up-level you as a trader. But first, before we dive in, I just want to let you know that we have a new webinar coming up. It's how to master multiple time frame analysis. If you are familiar with the streams, I talk about using multiple time frames in my own personal analysis and in my own personal trading. I'm going to show you how you can understand how to use multiple time frames to understand the market better and find better trading opportunities. So I'm going to drop the link to this in the chat so you can register for this whenever you feel like it. But head over to there. We're going to be hosting this on the 12th of August, 5 p.m. GMT +1, and hopefully you can make it. So let's dive straight into the chart check of the day. And we're going to be covering a few things. We're going to be covering Euro US dollar ahead of the FOMC interest rate decision coming up today. We're going to be talking about the pound US dollar and how that is shaping up ahead of the Bank of England decision tomorrow. And then we're going to talk about the skill of the day, which is how to identify ascending and descending triangles for opportunities. So let's dive straight into it. Let's go straight into Euro US dollar and see how the market is positioning itself right now. So we can see from a technical perspective and the price on the chart that we have pretty much just gone sideways. We're traded in a pretty shallow range really between the 113.50 and the 114.50 highs, and the market is really just kind of hugging this area. Now, why does this happen? Well, this happens when there is a lot of indecision in the market. There's a lot of uncertainty in the market. So instead of trying to or instead of understanding there is a clear direction, a clear winner between, let's say, the euro and the US dollar, there is a sort of fair value being built. There's uncertainty between which one is stronger and which one is weaker at the moment. So when it comes to euro US dollar, it's waiting for a catalyst, and that usually displays itself within a trading range. So when you do get one of these trading ranges form, it's ideal for opportunities to kind of trade the uncertainty and trade the range from the range lows up to the range highs. But if you're looking for sort of trend trading opportunities, they're very few and far between sort of seeing that kind of breakout. So we want to be looking for opportunities coming up, and the catalyst that is coming up is obviously the FOMC interest rate decision going into today, which is a biggie because it is starting to get a little bit closer to a pause in interest rates. So yesterday we were looking at the CME Fed Watch tool, and it said there was a 63% chance of a hold in interest rates. Now it's gone up to 70.6%, which is quite interesting considering the developments overnight. So overnight we've actually seen Iran strike different areas where US troops are based. And it came as a little bit of a surprise to the markets. We've seen Brent crude oil jump higher again. So there is some element of risk coming back into the market. And usually in that condition, or what we've seen recently especially, is that has seen US bond yields rise, the US dollar rise, which then reflects here on the CME Fed Watch tool, including an increase in the probability of a 25 basis points hike. Now, usually around this time of year, we do see an increase in volatility because not only do we have a new Fed chair coming in who is very aggressive on inflation, but we also have a midterm election coming up, right? So the midterms are approaching, and that can create a lot of volatility within the market. So usually in a midterm year, volatility will rise, which can often mean that, again, the dollar's a little bit more stronger in that environment. So if anything, what we're expecting from the Fed tonight is a pause, but it's what is said by Fed Chair Warsh. Now, he has come out and said he's not going to give any forward guidance, so it puts a lot of emphasis on the CPI data that we see, the NFP data that comes out, it makes those events a little bit more volatile because traders are going to be trying to read between the lines what this means for the Fed chair. So we'll be interesting to see what he says this evening, but I'm expecting a hold. I'm expecting a bit of a hawkish hold, and I expect him to try and say that because of the geopolitical tensions in the market, there is a good chance that we are hiking interest rates in September, and that's what traders are pricing in at the moment. If we go to the 16th of September meeting, we can see that there is a 76.5% chance of an interest rate hike coming for the Federal Reserve. So traders are going to try and price this move in. Now, there's a couple of ways that we can obviously do this as well. I'll come back to euro dollar in a second and what this could mean. But when we take a look at the US 2-year bond yields and we compare these bond yields to the current interest rate in the US, and we just go to a weekly chart, we can see that the US 2-year yields are trading at 4.25%, whereas we've got the US interest rate at 3.75%. So the difference between the two catalysts here, the two instruments here, is starting to widen, and when you see that widening, you often see a interest rate hike. So when we look at the US 2-year yields back in 2022, we saw obviously a huge increase in inflation between 2021 2022, and that saw bond traders pricing the idea that we're going to see rate hikes, and we saw a huge increase in the US 2-year yields. It was then followed a few months later by interest rate hikes. We're having a similar thing here now. The US 2-year yield is trading away from the current rates. So this is us suggesting that there's going to be rate hikes in the future. Now, looking at that from a euro dollar perspective, what would that mean? So if we are going to get interest rate hikes and then future rate hikes as well, that could be pretty bullish for the US dollar. So taking a look at what's happened here with euro dollar, we're kind of breaking down through the lows of this weekly range. So if we look at it from a weekly perspective, you've got 114 as the sort of weekly range lows, 118 or 119 as the weekly range highs, and price at the moment is consolidating at the lows of a range. Now, if you're interested in something called auction market theory, that is the theory that if price kind of forms a consolidation at a level of support or resistance, the likelihood is it's going to break it. So we need some potential momentum that going to drive price through that, and that catalyst could be the Fed decision this evening. So a couple of different options for euro US dollar going into today. We've got clear areas of support and resistance. Let me just add a proper level in here. So we've got 113.50. But to me, there is a couple of options. The first option is if we get a hold but a hawkish tone from the Fed chair, then the likelihood, I think, is we see euro US dollar trade lower. So I'll be looking for breaks of 113.50 with potential to see a move down into the 111.50 handle, where I am expecting quite a decent reversal at that point. Alternatively, if we see them hold interest rates and start to say things like, we think rates are restrictive enough, we think that the rate level is doing its job on inflation because inflation has cooled in the US, then there could be a potential for this to spike up into 114.50. Whether it can break above, we'll have to wait and see, but if it does, then that opens a move up to sort of the 115.50 levels, or if it doesn't, then we could expect maybe price just to kind of reject in and around that level. But the important thing is we don't want to be trading within the range, right? We want to be trading at the extremes of the ranges. So if we get up into 114.50 and it was a bit more hawkish, but price has just kind of shocked itself, moved to the upside, then I wouldn't mind looking for shorts at 114.50. If it is dovish in tone, then a breakout looks more likely. But if we do have this, which is kind of largely anticipated, that hawkish tone, then there could be a good chance that we break at 113.50 and move back lower. So a couple of different scenarios I want to keep your minds open to. There's a lot of uncertainty around this particular meeting, so it's good to have options of what we can potentially do. I don't want to predict the market and say I'm just purely short euro US dollar. I like to wait for the reaction first before starting to get involved with the move. Now, just to kind of add a little bit of a caveat to that, we have the currency strength meter. Currency strength meter is telling us that the US dollar is currently the strongest currency. Euro on the meter at the moment sits at -1. So not really that strong, but also not completely weak. Other markets that are weak is the Japanese yen and the Swiss franc. So the dollar could start outperforming on those particular currency pairs like US dollar against the Swiss franc and US dollar against the Japanese yen. So maybe you want to be looking at those markets as well going into the decision today. So let's just add a little bit more of, again, just kind of like a catalyst on here. I want to just take you through something that we found on the commitment of traded reports as well for euro. So if we have a little look at euro, we can see here that actually we are starting to see some extremes coming from the commercial side and the hedge funds. So when we look at the commitment of traded reports, these just open out here, what we'll be seeing from this is that they are starting to reach a certain amount of contracts which would be considered an extreme level over 6 months, 18 months, and potentially even 36 months. So here's the weekly euro US dollar chart here, right? You can see that reflected there. And if we look at the net contracts of the commercials, they are coming into a similar extreme that we saw back in January of 2025. And look what happened to price there. We saw euro US dollar rally quite considerably at that point. So that's why I said I like a bit of downside, and I like downside into that kind of what was it, the 111.50, because if we look at that weekly chart and we just zoom out, we had really strong resistance there and we had really strong support there. So it's almost like looking to see, can this price drive down into that level and then see a bit more of an extreme from the commitment of trader reports to see a bit more of a kind of break to the upside. Okay, so let's keep an eye on euro dollar. I do feel like downside is still the play for now, especially if we do see a continuation of the US bond yields moving higher. You know, if you see 2-year yields continue to drive up towards 5%, if you see the US 10-year yields drive up towards 5%, that's a big warning sign that the market is pricing in significant rate hikes, and the dollar will usually remain strong in that condition. So let's move on to the big story of today. As always, guys, if you have any questions, please let me know. If you are sticking around and watching, thank you. Like and subscribe. And as I said earlier, you can follow along to our webinar, upcoming webinar, multiple time frame analysis for beginners. So if you're interested in that, then you can see that there is a link in the chat that you can register to. We've also got a little QR code there for you to join the Anzo Telegram channel, where I post regular updates there as well, like all the price action that's happened overnight, as well as the upcoming events for today and some charts of interest there too. So if you're interested in joining the Telegram channel, please do so. So let's move on to the next part of the markets in free then. This is the part of the show where I like to talk about the big story in the markets at the moment. Now, obviously the big story of today is the FOMC interest rate decision. However, the big story for tomorrow is the Bank of England interest rate decision. And I want to prepare you guys for that. We spoke about the FOMC earlier and yesterday. So let's talk about the pound. So we were pretty bullish on the pound down towards this 131.50 handle. We really like the idea of being buyers down here. There was a really strong commitment of trader report signal there. And if I just bring that back up, open the British pound futures, you'll see that there was a really strong signal on from our hedge funds, who were heavily short pound towards these lows, which gives us the idea that that trade is crowded and that we could look for a reversal. And we saw a good 2-3 weeks of reversal in the price. The other idea I liked around pound was the pound was one of the strongest currencies on the currency strength meter at the time. If I just highlight the pound here, we can see that it was gaining strength from the sort of 30th of May all the way up into the 11th of July. But now we've started to see that strength taper off. And it's largely come down to the shift in political regime in the UK, because the data out of the UK is actually not that bad. If I go to trade and economics and we just go and have a little look at the United Kingdom here, if we look, for instance, at the GDP growth rate, that came in higher, right? It was expected to, or previously it was zero point 0.1, now it isn't at zero point 0.6. Obviously not hugely fantastic, but it's better news than what was recently seen. The unemployment rate is at 4.9%, which is a little high, but not anything too aggressive. Inflation rate came down, so inflation in the UK was coming in lower, growth was rising, and interest rates have remained pretty much the same at 3.75%, equal to the US. So in terms of like genuine data, the UK's data has not been too bad. It's actually been a little bit better. We had some retail sales data recently as well, which came out way better than expected too. This was expected to drop really significantly, and it only fell by a very, very small percentage. So in the UK, I didn't actually feel the data was too bad. We looked at the commitment of trader report, and we looked at the idea of being buyers down at this 131.50. Market formed that head and shoulders pattern, it broke out and formed a nice little sort of 4-hour trend. However, since then, price has started to kind of give that back. We've had a consecutive sort of breakout of higher highs, lower lows, lower highs, and I was monitoring this for a potential breakout and a move higher. But the dollar strength has just been so dominant here. We've just been, pushed back. Now, if you looked at other pound crosses, that's not necessarily the case. So if you look at, for instance, pound yen, we had again a really strong upward trend when we found those lows of the 131.50 and the market continued higher. Pound Swissy as well has continued to push higher too. So it's just the fact that we were looking at pound against the US dollar when maybe we should have looked at something a little bit different, like the likes of pound Swiss, potentially even pound yen. Pound Aussie's even starting to make its move back to the upside because of poor Australian data. So when I looked at the pound US dollar, it was like, I like the idea of being a buyer here, but the dollar strength was too dominant and it pushed this price lower. So, however, we do have that Bank of England interest rate decision coming up tomorrow. Forecasts are we are going to see interest rates remain unchanged. If I just bring in our interest rate tracker, in here we can see that the BoE 3.75%, 92% chance of a hold. They are leaning a little bit more hawkish. So let's have a little look at some of the data here. It says the majority of BoE bankers are hawkish, so that's neutral 4, hawkish 5. The overall tone is neutral because the majority of recent comments from the Bank of England policymakers reflect a cautious approach to monetary policy with a balance of risks and knowledge. While they are hawkish voices suggesting the need for potential rate hikes, the predominant sentiment among the majority leans towards maintaining the current rate amid signs of easing inflation expectations and a softening labour market. So that's why the unemployment rate was 4.9%, but we saw inflation coming in lower. So that's what that's just explaining there. Recent data indicates a decline in expected wage growth and inflation, suggesting that the financial conditions are stabilising. Additionally, the emphasis on monitoring the economic landscape for second round effects and the need of measured response indicates a preferred steady approach rather than aggressive tightening or easing. So this is all down to, like we were talking about earlier, that Brent crude oil situation. The situation between the US and Iran is having global effects, because if we see the supply of oil constrained, then oil prices will rise and that will have a knock-on effect globally. So the issue they have, or the issue that they're saying when it comes to the second round effects or the second round impacts of that recent rise in oil prices. So a lot of central banks are kind of holding interest rates, waiting and preparing themselves to what could potentially happen next when it comes to the US-Iran war. If we see escalations, a lot of central banks are going to lean towards being more hawkish, lean towards more rate hikes. So again, we've got the Bank of England. Usually when we have a Bank of England interest rate decision as well, it comes with what's called the MPC committee vote. If I can just show you here. So it says the MPC official bank rate vote. Now this is something that we need to look at when it comes to this particular event, because it shows us how many members are sort of wanting to hold interest rates, hike interest rates, or cut interest rates. So the first number in the format is represented by increases in rates. So last time we had two members wanting to increase interest rates. The second number is decrease, and the third number is hold, and 7 of the members wanted to hold interest rates. So if we see a substantial change in the voting, then that will obviously be a little bit more hawkish. So let's say it goes from 2 people wanting to hike interest rates to 3 to 4, and those that are looking to hold go lower. That is a sign that we are going to see a little bit more of a hawkish move in the pound. If we see this coming in as normal, same, then we probably won't get much movement. But if we see a bit more of a dovish side, so let's say some of them have taken away their, so let's say it goes 009, for instance, that means that the MPC have become a little bit more dovish in tone, and that can be negative for the pound. Now, looking at prices of pound US dollar, obviously we've got the FOMC to consider as well, but we had a really nice sort of inverse head and shoulders pattern that formed back here at the end of June, start of July. Since then, obviously, price has traded higher. We're coming all the way back now to test the neckline of that head and shoulders pattern, which is around 132.60. So if we do see some substantial change, and let's say for instance the scenario is the Fed are a little bit more hawkish tonight, then I expect prices to come a little bit lower here. But if it turns out, and actually tomorrow the Bank of England becomes a little bit more, a little bit more bullish, a little bit more hawkish, then I expect some kind of turnaround at this point as well. Maybe a break of that trend line which forms from the highs up here on the 15th of July. Maybe something like a break above 133.30 would be ideal to start being a little bit more bullish again on the pound. So couple of options to look for here. I think the trend here on the 4-hour is down, so I always try and stick with the trend. The dollar is one of the strongest currencies at the moment, so really speaking, this market looks more bearish than bullish at the moment. But obviously, with these two upcoming events, things could potentially change. So keep an eye out for those movements tomorrow. So we're going to be moving on to the skill of the day. The skill of the day is part of the show where I like to show you some kind of trading pattern, or it could be some kind of trading psychology, or something around kind of macro and things like that, just to kind of help you upskill yourself as a trader. Now, one of the most common questions I get when it comes to trading is, how do you enter the market? How do you get in on a move? Or what is your entry candle or whatever? And my answer is always the same. I use multiple variations of chart patterns that show me a potential change of trend. Okay, and that's all that chart patterns really do. So if I just scroll up the chart here, I'm just going to grab the pencil. You have things called the ascending and descending triangles. Okay, so we have a pattern basically where price forms almost like a base area, right, or a ceiling if it comes to the ascending triangle. Okay, and now the ascending triangle characteristics is pretty much where we start to see the market making sort of not making any new higher highs, but making higher lows, right? So we get this kind of like squeeze pattern, and the market just kind of like squeezes into a sort of tight consolidative range, and the lows are getting higher, and that's what creates this kind of potential breakout opportunity. Now, the way I like to trade this is that if price breaks out, we can look for one entry, first entry, and then it stops below the latest swing low. A second entry can be on the retest of that sort of breakout area, and then we can look for a tighter stop loss with a potential for the market to break higher. Now, the opposite to that is what's known as a descending triangle. So that's when price comes down and we form kind of lower highs, not really getting any lower lows, but we get kind of lower highs, and then we get this almost, again, sort of squeeze pattern. The market can then break out, and we're looking for sort of continuations to the downside at that point. And there's actually a really good example of one of these, especially the descending triangle on pound Aussie. And we actually took this a few months ago. When was that now? It was probably, it was up here. I remember posting about it back in December. Um, and we were looking at the continuation of this pound Aussie. I've still got the descending triangle drawing here that I sent out to everybody, because I liked the idea of the downside here. Now, don't get me wrong, this has to come with context too. You can't just look at every single chart pattern and trade it. It doesn't work like that. What it's showing you is almost like the momentum of buyers is not really kind of gaining momentum. If price is failing to make new higher highs, it's really struggling for buyers to take control of the market. Sellers are in control of this in particular. Now, when it comes to this potential, or well, this market move that we traded, and this is a daily time frame one, but you can look at them on lower time frames too. But we were looking at the fact that the RBA were increasing interest rates and the UK were leaving their interest rates on hold. So the RBA was hiking actively, and we're talking about continual hikes. Inflation was rising in Australia at the time as well. So that really was driving the Australian dollar strength in the market. Pound was a little bit weaker because there was slow growth. Unemployment was a little bit higher. So we started to see this trend develop. Now, what we also noticed was the fact that the market came into this level at 2 flat, and then it formed a base, right? The market rallied, it came back in, formed a bit of a base, rallied again, but this time it was a bit more of a shallow rally, so that's why it created the lower high. Market came in, rallied again, lower high. So we were looking for the breakout, and you can see here on the chart, if I just zoom in a little bit, we had the breakout, right? The break and close below. So that was our first short idea in there. Stop loss goes above the swing high. And when it comes to sort of ascending, descending triangle patterns, the breakout can be fairly aggressive, because price is almost coiled. It's ready to sort of explode. And this was one of those variations where that happened. We had a close below, entered short, stop above the high, big move to the downside. But these patterns happen everywhere, and you can trade them at different sort of points as well. So let me see if I can find a sort of an ascending triangle sort of pattern. I don't know whether there'll be one on pound Aussie. I'm trying to think if there was one on gold recently where we had a bit more of a pattern going on. Let me just have a quick look. So we've had a head and shoulders pattern. So again, this is a bit more of a descending triangle pattern that formed yesterday on gold. Not the ascending one, but I'll try and see if I can find an example. But even, you know, price was rallying here, but we gapped. The market then formed lower highs, right? But there was a base sort of line at the $4,080 level, but we were getting lower highs. Market breaks out. That's your first trade. It comes in, retests. Here's your second trade. It's almost confirming what's going on, and then we've seen that kind of breakout and move to the downside there. Okay, so let me see if I can find one. I'm pretty sure there was one recently on gold, which is why I'm kind of thinking about it a little bit. There's kind of one here. It's not the cleanest of ascending triangles, but you can see there's kind of like a base that's formed round about that, again, that $4,080 level, but you can see the lows again in higher, and then we get a breakout of that ascending triangle. If you entered there, stops below the lows, try and target at least a 2-to-1 risk reward ratio. I want to try and see if there's a bit of a cleaner one. Gold has obviously been pretty bearish recently, so you know we might not get too many of those ascending triangles. But look here again, right? Market's trying to pull back, it then finds a bit of a base in here, and look what happens to the highs. They get lower. So you got high, 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 which are all lower than each other. Breakout, market breaks out, pushes to the downside. So there's lots of like ways that you can use this pattern. Okay, here we go. This is the move that I was probably thinking of the most. This was on the weekend, this was on Friday, but you can see again, market's just finding a bit of a ceiling here. We pull back, we then make a higher low, we go into that level again, higher low, market closed like that. We then gapped over the weekend and you know traded higher. So that would have been a bit more difficult to trade, but you know, let's say there was a breakout candle here, buy, stops below the low, and a move to the upside. So there are different variations of, and they don't look as clean as obviously the ones I was drawing out earlier, but there are some really good examples of how you can use this pattern in the markets. But what I would always say is use patterns with context. Don't just trade them blindly. They do not work if you trade them blindly. But if you have context, for instance here, price is trading above the 200 moving average, trading above the 50 moving average. That's a sign of a bullish trend. Market moves higher. At the time here as well, we broke down, we retested a neckline resistance of the head and shoulders pattern, and look what happened. We failed to kind of make new higher highs, broke out, moved to the downside. So remember, context always matters first, and I always kind of come back to my 3-step trading method, which is why, conditions, strategy. Look at the why. Why should a market be doing what it's doing? Are the conditions matching it? And the strategy could be looking for those ascending and descending triangles for breakout opportunities. Okay, so that's it for today. Thank you for joining me for the stream. We've covered a lot today. We've covered the euro US dollar, the key levels ahead of the FOMC meeting. We've covered the Bank of England meeting as well, coming up tomorrow, and looking for those MPC committee votes. And we've also talked about ascending and descending triangles. Just a quick reminder, I do have that webinar coming up on the 12th of August, Master Multiple Time Frame Analysis. I'm going to show you how I use multiple time frames to trade the markets. So please join me for that one. The link is already in the comments section, so head over there. You can also see the QR code on stream for the Anzo Telegram channel. So thanks for joining me today. Really appreciate it. If you did like the stream, please give it a thumbs up. Subscribe if you're new around here, and I will speak to you tomorrow, 9 a.m. GMT.